Hello everybody, FLCT's full year 22 results are out now, and this is the weekend after the famous CPI print in the US, where inflation finally showed sign of cooling, and you see the REITs markets are now in the sea of green. So that's pretty good news, I suppose, especially for those people who have bought during the extreme pessimism over the past few weeks. Of course, it's not clear whether or not these green shoots will be here to stay, because one print does not a trend make. So it depends on the CPI print in December the 13th, of course FOMC in December, and so on and so forth. But nonetheless, I think we're starting to see some green shoots happening. So for this REIT, the results are pretty nice actually. I would say that for this REIT, too much cash is actually a good thing in this environment. So let's talk about it. So this is the share price and how it has done over the past 1 year. You can see it's completely the collapse, right? From 150 to like $1, man. So like 30% down. It's crazy. But of course, this is a pop-up post the CPI print, right? Where REITs just read it like 6 to 7% overnight. So that was unbelievable, right? This market is crazy. So if you compare what's happening on the 1 year perspective to the other peers, actually this stuff has kind of underperformed, right? Together with KDC. Actually, I will compare FLCT to Ascendance REIT. So it's now Capital Land Ascendance REIT. You can see actually it's underperformed the A REIT quite a fair bit. Actually, I felt both are quite comparable. Both are like logistics, industrials, and commercials. Very strong fundamentals, but yet this guy has underperformed. Well, I would have bought it if not for the fact that I already have quite a lot of it, and I was actually buying other stuff like Ames Street and Sahil and so on and so forth. I thought about it previously in another video, so I'll put the link over here and you can go check it out. You can see, wow, this year has been a bloodbath for the REITs. So the main thing was of course the divestment of the Cross Street Exchange by FLCT at a very good price. I think $800 million, right? Fantastic. Quite interesting. This was the report that you can get if you Google. And the buyer is a private equity player in Hong Kong, and they want to upgrade the facility, which is quite interesting, right? Because FLCT actually upgraded did AEIs quite extensively to this property quite a few years ago. So now this guy is trying to buy it and then reposition it to value add in the future. But nonetheless, it's a good opportunity and a timing to sell this stuff, because now this guy, this REIT is extremely cash rich, right? So let's look at the numbers. Not that surprising. Revenue is down because they sold the Cross Street Exchange, right? But then they did some deep accretive acquisitions. So the impact to the revenue top line is not that extensive. They reduced the finance costs, obviously because they paid down their debt using the proceeds of the sale. So therefore, the DPU would have dropped, but they did a capital top up, quite a fair bit, 11 million more than last year to top up the DPU. So the DPU for the full year was 7.6 cents versus 7.68 cents last year. I think what happened was that they wanted to top up the DPU to offset the losses of the income from the property, but they did not want to top up to cover the FX depreciation, right? So the DPU on the full year was down quite marginally, but I think it's a sign to the market that they will not use the capital from the sale of the property to top up FX differences and interest rate differences to top up the loss of income from the property, which I think is very fair, very prudently done. I quite like it. So if you look at the FX moves this year, right, it's nuts. Euro is 8% down versus Sing. Sterling is now 10% down versus Sing. Man, Sterling is a rough time. Rishi Sunak has a tough job ahead of him. Aussie is down also 7% against the Sing. So the FX headwind for this REIT is quite heavy, especially now that they sold CXE. So they have only one Singapore property left, I think, in ATP, Alexandria Technology Park. So that's near Harbourfront MRT. Actually Labrador Park MRT is closer. The rest are all in Australia, Netherlands and the Germany's and the Northern European countries, and of course the business parks in UK. So FX headwinds and fluctuations with a pretty decent effect on this REIT. So let's look at the debt. Oh, this is like, that's why I say, right, too much cash is a good thing. The leverage is now 27% only. I think this is like the one of the, if not the lowest in the S-REIT space. 27% only, no. Cost of borrowing is quite low also, but it will rise. fixed rate at 80%. ICI is 13 times, man. So I think there's nothing to worry about in terms of ability to refi their debt and so on and so forth. I'm not even bothering to talk too much about it. It's cash rich, dude. Look at the balance sheet. Quite surprisingly, NAV is actually up from 1.24 to 1.3. So if you look at it, it's quite interesting. The valuation actually spiked up quite massively for their logistics and industrial properties. So up 9% for the Australian ones, 12% for the German and the Dutch ones in the Eurozone, and the UK is also marginally up. I think what's happening for these properties in the West is that because these properties, the rentals are indexed to CPI, right? And CPI is now massively higher. I think what's happening is that this carried over and therefore impacted the valuations. And all this stuff is actually valued higher than before. Quite a fair bit. I think this has a positive read through though to the industrial and logistics space. So I was quite happy to see these numbers because this will have quite positive implications for some of the other industrial REITs that I bought, especially AIMS APAC, right? So I bought AIMS APAC quite aggressively over the past few weeks. If you have been following this channel, you know I went a bit nuts about buying AIMS APAC. So I'll put the link to the video over here. You can go check it out. And the commercial properties are quite flat though. So like down just smalls, up smalls and down smalls in the UK. So you can see UK commercial is also quite rough times, especially with the deep recession coming soon. You can see that the BOE governor was warning, right? If rates were what the market were predicting, then we're heading for a 2-year recession in the UK. So I think the commercial properties in the UK are quite rough. But I think the read through from these numbers is that logistics and industrial properties are actually doing very well, be it Eurozone, Australia, or in the UK, all very good because of the pandemics and the effect on the logistics chain. So I think this stuff is still doing very well. Quite happy with what I bought so far. So if you look at the properties that I had, especially the WALE, which is very important, 5 years WALE for the logistics and industrial arm, and 4 years for the commercial. So I think the rental and the top line contribution will be very consistent for the next few years. Very steady shape if you think about it. Top line will be stable, bottom line will be stable also because they have the power of capital top-ups. And anyways, their leverage is very low, right? So rising interest rates will not hurt them that bad. So very steady shape. I think the key thing going on will be what's going to happen next, right? Because they will not stay at 27% gearing forever. I think they will just beat their time, wait for acquisitions to be possible on an accretive basis. Because now with the cost of debt rising so fast, cost of equity also rising very fast, the spreads for doing acquisitions is not that ideal. So I don't think they can do much accretively anymore for the time being until the central banks let up on their interest rate hiking paths. So in the meantime, I think they'll just wait, then do capital top-ups, and then fire the bullets once the opportunity comes. So hey, positive times ahead, I think, on this steady ship. Good luck, everybody.